This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every week, you know who it is. It's Rob Reinhold.
Hello, everybody. It is nice to see you here. And I am from Maverick Trading, Maverick Currencies, and the new Flat Earth Trading Society. If you want to see a crazy trading experiment, hop on over to the Flat Earth Trading Society.
Now, we prefaced episode 46 and episode 45. Said this is going to be a little bit of a compendium to something we talked about towards the end of that episode. Now, this is going to feel like more of a money management podcast episode. And it is somewhat, but it is also a trading psychology episode. And over time, I think you'll understand why. But this is a Robb episode that he put together. So, Robb, I'm going to go ahead and let you kind of run with this, and I'll jump in where appropriate.
In last week's episode, we talked about, again, not just trading to survive, but we talked about what to do with the money and how to get your account to truly grow. And we talked about how detrimental it would be to take money out of your account as you're in your growth phase, because every dollar you take out slows it all down. And in last week's episode, we said we're going to teach you a way to speed it all up. So that is what this week's episode is about. It's about feeding your account, and it's really going to be about a simple concept called compound interest. I know we've all heard of compound interest. I remember learning about it in school. We got on calculators, and it was all really good. I didn't truly understand compound interest until I lived it. And Einstein has a great quote. Einstein calls compound interest the eighth wonder of the world. He says, "He who understands it makes it, and he who doesn't pays it." When I got enough money and I started to see what compounding growth actually could do, I was blown away. Like I said, I learned it in school. I've gone onto the calculators. I saw it. But once you start to see it in your accounts, it is amazing. And to understand the concept, this is where you truly need to get psychologically to where you understand it. Once you know it for a fact, it's much easier to follow.
And on the other side of that, too, you might be thinking, okay, I understand how compound interest can work for me, but how would it work against me? I've given this example before in my investing podcast. I think the best example of how it works against you is credit card debt. So if you, and trust me, we've all been there, if you don't pay your credit card off like you're supposed to, or if you just pay the minimum the entire time, that percentage just gets bigger and bigger and these things accrue. And so now, and you just get completely buried. That's why these credit card companies have been so rich for so long and aren't going anywhere. Rob, I'll bet you in 30 years we'll have the exact same three major credit card companies out there because they print money because they use compound interest at your expense. So if you can find a better example of how it works against you, I'm willing to hear it. But I think that's probably the best example out there.
I want to just drop in the home mortgage. Now, look, owning a home is great. I've owned a home for many years. But when you really look at an amortization schedule of your mortgage, with your first $2,000 payment, $20 is going to principal. It's such a ripoff. It's even worse than the credit cards. The mortgage business is an absolute scheme and a scam. And we all need to do it, though, sadly.
Or you can just rent. I'm so much after having a mortgage and having a home and being buried because I bought at the top. Yeah, I can say there's sites out there that even explain, hey, Cardi B just went nuts about this. She can't believe that when you buy a home that the mortgage isn't all you pay. You pay so much more than that over time to where when you rent, you don't. So maybe there's a little alpha there. I don't know if you already own a home. I hope you do well with it. But yeah, that's a really, really good example too.
This is a completely different rabbit hole that we even planned on. We didn't even talk about this. But if you want to go down a cool rabbit hole, really look at owning versus renting. And there are some cities in America where it was better for you to own, but the vast majority, it was better for you to rent and then invest all your extra. Now, if you rent and spend all your extra, it's way better off to buy a home. But if you rent and invest your extra amount that you didn't spend on housing that you would have with a house, then it really beats it mathematically.
But Rob, you don't actually own it. You don't have equity in the place you actually live. These are the narratives I fell for.
Look at the equity in your bank account and your trading accounts. That's the equity that you, quote unquote, would have had in your home.
100%.
All right, well, that was a left turn that we did not expect, but we really wanted to talk about feeding your account. And last week we talked about how detrimental it is for you to pull money out of your account. This week we're going to talk about how beneficial it is for you to feed your account, to put money in your account on a regular basis. And the reason why this works so well is because of compound interest. Now, a lot of you are going to say, okay, we get it. What does this have to do with psychology? When somebody believes something, they do it. Psychologically, what happens is when we don't know something for a fact or it's still unproven, all of a sudden then our minds get a chance to deviate and kind of plan out other realities. When you have the truth in front of you, then not choosing it is a mistake. It's not a psychological at this point, it's a mistake. So this episode, I want to go through the math. I want to prove to you it works. And then we'll talk about flipping the switch psychologically to actually take action on this.
And I did a bit of this too on my channel in a very, very, very simple, crude way. So I get a lot of pushback on a lot of my videos because I was bringing in something that nobody had ever seen before, and they'd done things one way this entire time. And that's really hard to get people to shake. Now, when I put up my risk video, oddly enough, I hardly got any pushback from that because I opened it with a little bit of psychology. I'm like, look, right here on this spreadsheet, let's just say, just for the sake of examples, that every win you get in the Forex market is a 50 pip win, and every loss is a 50 pip loss. Not realistic, but just for the sake of this example. Now, everybody is out there trying to chase more winners. With technical analysis, that's what we obsess over, right? Now, let's say I was able to get you 3 more winners a month. Let's see what that would do to your bottom line. And I showed him. I said, okay, let's get rid of that and go back to where we were. Now, let me show you what I can do if I eliminate 3 losers. And I did that, and the bottom line came out the exact same. It's such a simple thing. It's so obvious. You're like, oh, why didn't everybody already know this? But you just got to show people. And I think that shifted people's mindset just enough to where they're like, okay, this guy has a point. Let's see what he has to say. And then I got everybody on board, and that ended up being one of my most popular videos. It's just a little bit of a psychological shift. Like, I'm looking at the outline right now for this episode that Robb put together. There's so many things here that I didn't really realize or understand. But once you explain it a certain way, now it kind of makes sense. Me, the guy who put together this whole money management playlist, is looking at something that I've never seen before and saying, okay, this might, normally if somebody were to come to me and say, hey, here's a good way to make more money every year, I wouldn't give them the time of day. But looking at this, I kind of see it now. So what I would ask of you, the audience, is to approach this with an open mind. This is something pretty slick. And I think if more people adhered to this, good things could happen long term. So Robb, I hope I introduced you well on this one. So I'll let you take it from here and explain what you have.
Thanks, Patrick. Before we really jump into this, I've talked about my kids a lot. And as a dad, my kids are now adults. And as a dad, I wanted to program these kids. Now, we've talked about programming in this podcast, and we spent the first couple of episodes talking about all the negative programming that you get as a child. And I decided I want to do the opposite with my kids. I want to just totally positively program my children. And one of the things I always said to them, I said, getting wealthy is really simple. It's not easy, but it's simple. Everyone has to have a job, everyone has to work, and everyone has bills. The first thing you need to do, and again, I'm teaching kids here, teaching 6, 7-year-old kids, so I had to keep it simple. First off, you have to make more money than you spend. That is just the first thing you need to do. Number 2, you have to take some of that extra money and you have to invest it. And I had to explain to them what investment was. And again, it's just a 6-year-old, 7-year-old. So how can I explain to them what investment is? I said, something you can buy today that would be worth more money tomorrow. And again, not tomorrow, but in the next couple of years. And my kids got that. And I feel like a lot of people, a lot of adults are out there in this world and they're kind of flailing around and they have no idea what to do with the money when it's a simple formula. It's not easy because life is hard. Things come up all the time, but have to have some extra, and you have to put that extra into something that will grow bigger over time. That is basically compound interest. And I told them you have to do it every month. Every month, whatever extra you have, some of that has to go into an investment. Now, look, my kids are now in their early 20s. I can't say that they're really doing this now. They're doing it somewhat now. But look, I understand what early 20s are about. Sometimes you don't have a ton of money. But look, I wanted to program them that way, and I really want you to understand that. What I want you to do if you are behind a computer, please go to a compound interest calculator. Now, if you do a Google search, I want you to put compound interest calculator monthly because we want it to be monthly compounded. And I want to show you what the difference is if you just feed your account a little bit. Now, again, we're not talking about getting a better return. We're not talking about having more winners, less losers. We're literally talking about what is the difference going to be if you feed your account a little bit every single month. So I went onto a website called investor.gov. You can go wherever you want, but you can go there and run these numbers. Now, I want you to run the numbers for you. I'm just going to put some random numbers in there just for an example, but I want you to put in you, where you are right now, and what you have extra that you can put in. So the first thing I did, I said, okay, let's take Trader A. Trader A, let's say he or she starts with $10,000, and let's say they get a 24% yearly return. Now look, if you know what your yearly return is on average, put it in. If not, give a good estimation for that. But Trader A, starting out with $10,000 on a monthly compounded interest, that trader will have $12,682 after 1 year. After 3 years, they'll have $20,398. After 5 years, $32,810. And after 10 years, $107,651. So that is going to be the growth of that account. In 10 years, it's going to be $107,000. 5 years is going to be about $32,000. Then let's say Trader B. Let's say Trader B looks at their life, understands, okay, I've got bills, I've got income, I need to make more than I spend, and I need to put extra and feed my account. So Trader B starts with $10,000, 24% yearly return. This trader's putting $200 a month in. So it's $200 a month. After 1 year, they're at $15,364. After 3 years, $30,797. 5 years, $55,620. After 10 years, that trader's account is at $205,303. Basically, double the other trader. Both of these traders did the exact same amount of work. They made the exact same trades and they made the exact same return, but one of them fed the account with a little bit more every month, and it doubled their efforts.
Okay, so two things. One, if anybody needs a visual of this, look down in the show notes because I just put it down there for you. And if you want to rewind a little bit and follow along with what Robb was saying, I think it helps to have those numbers in front of you. So I think that's probably the easiest way to do it. So look down there to see this difference, how you can double your money in a 10-year time frame. But I would push back on a couple things here, Robb. So my programming has always said, you don't really want to take any money out of your trading account because you want that to be able to roll over time. Now, I understand that 24% year over year is not a very realistic number. I understood why you did it, but I'm having problems here because am I going to have $200 a month to even take out without breaking even or without losing a little bit of money in my trading account? Because on the surface, that doesn't sound appealing to me.
So this is going to be new money you put into the account. You are not taking any money out of the account. You are simply feeding more money into the account. This is very similar to someone contributing to their 401k at their job or putting money into their IRA. You're not taking money out. You're doing your trading, you're doing everything, but on top of that trading, everything you're doing, you're putting $200 a month in to speed up the growth of the account.
Okay, gotcha. And if people out there do trade other instruments, metals and crypto and things like that, 24% yearly return on average is probably not out of the question. It just seemed a bit high. Where did you get that number from?
My ass, to be honest with you. Look, it's your yearly return is your yearly return. What you trade will determine your yearly return. How much risk you take per trade will determine your yearly return. How active you are will determine it. Look, your yearly return is going to be totally different than everyone else's yearly return. And until you have your numbers down, and you've done this for a couple of years, it's all going to be theoretical.
Gotcha. Okay, so if I can just find a way outside of my trading account to add $200 a month into it and then use that to compound, that's where you're getting these numbers from, correct?
That's exactly correct. And that's why this episode is called Feeding Your Account. One of the reasons why 401ks work so good. 401ks are really lousy investing vehicles. They usually have lower quality investments with higher fees. So people that put money into 401ks, they get less return than the S&P 500. However, because they contribute every single month and because they get a match from their company sometimes, most people that start a 401k in their 20s and do it their whole life, they end up with millions of dollars at the end of their life. Why? Not because the return was great, but because they put money in every single month and they got free money from their company that they worked for, and all of that compounded at lower rates than the market average, it still turned into millions of dollars. You've got to be feeding not just your trading account, but look, I understand not everyone has tons of extra money, but let's say my kids at the end of every month, since they were 20 years old, they bought one silver coin, a 1 ounce silver coin that right now is what, 20, 22 bucks, somewhere around there. Let's say they did that their whole life. How many coins would they have at the end of their life?
I don't know.
And look, I'm not going to do the math either. Look, they're not going to have $1 million, but what they will have is they'll have something. And that's just 22, 23 bucks a month. What if you can do 50? What if you can do 100? What if you could do a 1/10 ounce gold coin every single month? That means every year you're buying 1.2 ounces of gold, and you do that for 50 years, and you get the growth in gold. That's going to be really, really amazing for you if you do it. Feed your accounts, feed your investments.
Yeah, and with so many people out there, and you see the headline all over the place, all these families and all these individuals too, that don't even have $400 in emergency money should things go sideways. And people still living paycheck to paycheck. That's a lot of people. They might say something like, well, there's no way I could do something like this. Well, you probably could, and if you force yourself to do it, and it just becomes part of every month that goes by, that's going to be a totally different story. I bet if you look at these people, Rob, who have these financial hardships, and you look at the money they actually do spend and where they spend it, it's money that could easily be allocated elsewhere.
Well, this is exactly where the psychology comes into this, because the math is the math. The psychology part of it is it's simple, but it's not easy. This is really hard to do. And I want to give you a personal story of my first probably 5 to 10 years. I started in my early 20s as a trader, and my first years were really good. I had a really bad year in 99. I had some really good years after that. And I made good money. And there were several years in there where I made in the low to mid six figures. Now, again, I'm a 27, 28-year-old kid. I got a family, but I'm doing really well. It was so frustrating to me that at the end of the year, when I sat down to do my balance sheet and everything, my balance sheet hardly grew. And I was like, how is this happening? How is this happening? I'm making good money. How's it happening? And when I really looked at it, a little bit went here, a little bit went here, a little bit went here. And after, 5 to 10 years of really working my butt off at trading, I didn't have as much to show for it as I should have. And I determined right then and there that I was going to commit to making it stick. Now, this is my theory, and I teach all of the Maverick traders this theory, making it stick. It's very easy in life for you to spend money. Your car breaks down, you need new tires. I get it. All that stuff happens. How do you make it stick? For me, I was young and impulsive, and I needed a way to make it stick. So I decided that I was going to have everything done completely automated. That I didn't even see money hit my account. It was already deducted. It was already moved here. I had my banking set up to where money was just shooting all over the place, going to this account, going to this account. And I made it to where I took it out of my hands because I always had plans. Oh, I'm going to do something next month. And when I finally sat down and I automated everything and I made it happen, over the next couple of years, I did not have the same problem. Where at the end of the year, I looked at my balance sheet and it has some really, really substantial growth. And then I finally understood, oh, I need to make it stick. I need to take the extra money I have and put it into something that is going to be there 5 years from now. That's my theory called making it stick. I really hope all of you take on that theory. Whatever extra money you have, make it stick. It's so easy for it just to evaporate and go away. Make some of it stick. And in a year, 5 years, 10 years, it'll still be there and it'll be worth a lot more.
Yeah, you just really have to make yourself do it. Like, great example, Maverick Trading's desk fees. That's money every month. And if I all of a sudden stopped trading with Maverick because I was, running short on money, which trust me, especially in the early days I was, then I was pretty much giving my future away. So I was like, okay, no matter what, I got to pay these desk fees. It's just something that comes out of my account like a lot of other things do. And it's just what it is. And people can do that on the other side too. Instead of something that's an expense, you can take that money and put it back in. I know, like I said, to sit there and tell your average person to put away $200, every month is a tall ask, especially in certain, depending on which country you're listening to, $200 could be a lot of money too. I get that. And it doesn't have to be 200, right, Rob? Like how do you scale this down? Let's say I'm from a place to where, the average monthly salary is like $500. What's my best approach here?
Well, let's make this fairly easy and straightforward. If it's $0 today, you'll have $0 tomorrow. If it's $10 today, maybe in a year it's $11. It's all about the rate of return. So that's why I directed you to go to calculators, to where I want you to see what is $10 a month worth in 5, 10, 15 years. And this is where, when I get people to know it for a fact, when you see the numbers, and that's just math. That's not anyone's opinion. That's math. All of a sudden, that $10 that seemed like such a big deal to you today, when you see that number at the end, it's not that big of a deal. And then the great thing is, it is contagious. And this is what happened to me. I started putting a little bit away, and all of a sudden I saw this growth. Now I wanted to put more away. Now I'm looking, hey, what can I cut out over here so I can stick more in these accounts and get it growing more? And all of a sudden, I then turned into a miser, which my wife did not love, because I wanted to stick every single extra dollar we had in some sort of investment, and I wanted to spend nothing. We had to meet in the middle ground. I'm no longer like that, but it gets contagious. It is fun.
I agree with. I'm over here going crazy on the other side of the microphone. It's it is to the point to where it's contagious to a fault. Like, if you're going out on a date and the question always comes up, what do you do for fun? And you say, well, the thing I really love more than anything is saving my money and investing it in different things. That's going to be the most boring answer you can possibly give. But that's kind of, especially nowadays, that's where a lot of my spare money goes. I like investing in things that I think are going to do really well in the future. It's exciting, to where a lot of other things are less exciting. I don't know how else to explain it.
One of my favorite sayings that my wife has always told our kids, she says, do what you have to do today so you can do what you want to do tomorrow. That is right along these same lines. Look, it's hard. It's hard to save up that money. It's hard not to spend it. It's hard. I get it. But it will absolutely be worth it. For me, I had to automate everything because psychologically I just wasn't there yet. I was still young. I was still immature. I still was not able to handle it. I had to automate everything to where it was taken out of my hands. Then once I saw it work, then all of a sudden my psychology flipped around to where I had no problem. I actually had a problem of living a life that was worth living instead of just sticking every single dollar away.
And that's really it. That's, I guess, the point I was trying to explain earlier, is that if it just automatically comes out of your account, it's a lot easier psychologically to wrap your head around. If you have to physically take it out of your account and put it somewhere else, then that's something you're not going to want to do every month. So if you just automate, like, Maverick desk fees have always come out of my bank account. That's just how it is. This is what happens every month. So whether you like it or not. So I think that's really a key takeaway, guys. If you are able to automate this particular step and not make it something you force yourself to do every month manually, then it's a lot easier to do. And then also, like we said earlier too, once these things do start to compound and you start to see it in front of you, then it becomes addictive. You're like, wow, okay, I did this in the span of a year. What else can I do if I just keep up? How far can I go with this if I just keep at it? It actually does get really, really exciting. But you just have to find a way to make it happen first. And I think automating it is the best way to go. So Rob, do you have anything else before we wrap it up here?
I actually do. And I want to go back to this theme again of fun. Procrastination is simply life's way of telling you you hate doing something. I heard that quote years ago, and it totally changed my viewpoint of procrastination, because before I would procrastinate something and say, ugh, I have to do it. Now I'm like, oh, I hate this. I hate doing this. And now I no longer force myself to try to do the things I hate, because guess what? I'm going to fail at them because I hate doing them, so I'm not going to give them full effort. So you need to make this fun. Now, I know, Patrick, you're a gold bug. I know a lot of gold bugs. This is what someone who's a gold bug, this is what they should do. They should say, okay, I get my paycheck twice a month. And at the end of this month, I'm going to save up enough money to walk down to the coin shop that is a couple miles away, and I'm going to buy a 1/10 of an ounce gold coin, and I'm going to put it in that's going to be my first coin in my collection. And so you take that coin home, you hide it wherever you hide your valuable stuff, and every so often you take it out, you look at it, and then guess what? Next month you do it again. Pretty soon, you do that a couple months, you're going to have this little pile of gold coins that oh my gosh, if the shit hits the fan, I can take any one of these and cash these in immediately. But guess what? I don't need them right now. I'm just going to keep building up my pile. Do you see how all of a sudden this process becomes fun? It's not something you have to fight to do. It becomes something you look forward to. Like, oh my gosh, I made enough money this month to go buy 2 of these coins. Go buy 2, you come home, you add them to your little pile. It's really fun. Find a way that this isn't a struggle, that this is actually something you want to do. That's the secret of doing the things you don't want to do, is make it something you want to do, because then you give the full effort to it.
And if you want to go the automation route, you can do this with Bitcoin. There are companies out there that will do it for you. Swan Bitcoin is one that I can recall off the top of my head, but it's almost just like you're saving for like your child's college fund or something like that. That's how they verbalize it. But whatever you're doing it for, it just takes a little bit of money out of your account and just transfers it over to Bitcoin, and then little by little you start stacking sats, and by when it's all said and done, you have 1 or 2 Bitcoin, which could be really, really nice. It's really, really nice now, but it could be really, really nice going forward too.
And not to keep going on and on about this and recommending companies, but there's one other company I wanted to recommend. It's called Acorns. I don't know if you've ever heard of it. It's literally, you sign up with this company, and every time you buy something at the store, it rounds it up to the next dollar. So let's say you went to the store and you bought something for $8.50. It would charge you $9 on your credit card. And it would take that 50 cents that added on, and it would invest it in the S&P or whatever other investment you wanted. Every time you went to the store to buy something, okay, you went to the store and something was $21.12. 88 cents now goes into, because it billed you for 22, 88 cents goes into your investment account. These are the things. There's lots of companies out there that can help you and will help you with this, and you will never notice it. You don't care that it was $21 or $22 when it was really $21.12. You don't care because you didn't even see it, but you're going to be building something. Look, that's not a lot. That's pennies, but they will build this something. If you do zero, you'll have zero.
And if you don't think this is a good idea, understand your grocery store thinks it's a great idea, because this is what a lot of grocery stores do. They're like, would you like to, if you spent $22 at the grocery store, would you like to round up to $23? Even if it's, 10 cents here, 15 cents here. To that grocery store, these things add up so much, and then they give it away to charity, and it becomes a gigantic tax write-off for them. They love it. So again, this can work for you, or it can work against you. Choose to make it work for you. I wish I was doing these things a long time ago, but I just never got the information, and I never had anybody make it make sense to me. So hopefully we have done that here in episode 46, and we thank you for listening to episode 46. We will both. See you next week.
Goodbye, everybody.